Hi everyone, welcome to this session. In this session, we will discuss the evolution of Fed's strategy of monetary policy. So, in the previous session, we had discussed that there are mainly two intermediate targets, that is the strategy of monetary policy of using intermediate targets. One is targeting monetary aggregates and the other one is interest rate targeting. So, in this session let us see the evolution of Fed strategy over time by the Fed. So, in the years since 1970, the Federal Reserve's emphasis has varied between controlling the interest rate and targeting monetary aggregates. That means they have been interchangeably using either of interest rate targeting or monetary aggregate targeting. So, twice during this time period, the Federal Reserve dramatically shifted from one strategy to another. So, then in 2008, as you know, because of the 2007-8 financial crisis, a further shift was necessitated by the severity of the financial crisis. So, the Federal Reserve strategy as well as the reason for this shift, let us review this by looking at several sub periods. So, from the period 1970 to 79, for this period Federal Reserve strategy in the 1970s was one of interest rate targeting. So, as is the case today, the rate targeted was the Fed fund rate, that is the Fed fund rate, that is the interest rate Fed had targeted at that time. Now also they have been using the same for the interest rate targeting, they have been using Fed fund rate as the instrument for that. So, the strategy was not to peg the rate at any one value for a long period of time. You know that Fed fund rate over period of time they have been changing it. If you see that the FOMC meeting, that means 8 times in a year they meet, and every time either they retain or change. Most time they change the Fed fund rate, that means the target rate was reconsidered at each FOMC meeting and adjusted as deemed necessary in light of the state of the economy. So, it does not mean that monetary aggregates were not neglected in the 1970s, although a month to month basis interest rate targets was given precedence. In the another period from 1979 to 82, there is the first dramatic switch in the Federal Reserve policy by targeting monetary aggregates. That means dramatic switch of Federal Reserve policy came on October 6, 1979, when the Fed abandoned targeting the Fed fund rate. The main reason was due to the accelerating inflation rate in the 1979. So, it here by abandoning the Fed fund rate, it adopted a strategy of directly controlling bank reserves to increase its ability to hit target ranges for growth in monetary aggregates, especially M1 and M2. So, in the 1970s, as I mentioned here, there was ever accelerating inflation was there. So, the recession that many had expected during the year had not materialized. So, there was a great deal of uncertainty about the strength of the private sector demand as well. Because all these reasons, Fed followed, that means focus more on the monetary aggregates, because of the expectation is that by directly targeting on monetary aggregates, it can control the inflation, the ever accelerating inflation. Then the further evolution, we can see that between 1982 and 2008, there was a gradual return to Fed fund rate targeting. And not only that, during this period the Fed was following a kind of implicit targeting as well, implicit anchoring, not really highlighting, though they have been using Fed fund rate targeting, that the interest rate targeting, but overall they also followed an implicit anchoring, that not using a explicit nominal anchor, for example not highlighting FFR as the nominal anchor. So, whenever is new information comes and depending on the situation in the economy, they have been following some nominal implicit anchor in order to achieve the final outcome. However, overall we we can say that they have been continuing with the FFR targeting, that is the interest rate targeting, by abandoning the monetary aggregate targeting. So the main reason for that, the reason for abandoning the monetary aggregates targeting was that the relationship between money income, there was a breakdown due to the breakdown of the money income relationship that was observed in the 1980s. It forced the Fed to abandon the money supply monetary aggregate targeting, and then again switch back to Fed fund targeting. So, especially the instability of money demand, that also what a phenomenon happened in the 1980s, and as a result overall there was a breakdown of the money income relationship in the 1980s. Then during 1994 2012, though they have been following FFR targeting, there was a move toward a greater transparency. That means forward looking monetary policy announcement, not giving any surprise, giving a clear cut idea what are the monetary policy going to happen in the coming days. The objective was to give more transparency in the monetary policy. So, announcing the forecast on the FFR by FOMC members, and also without name identification, or they also give the future values of Fed fund rate. That means giving more hint to the economic agents about what is going to happen, what is the monetary policy look like. Then in 2008-2012 we can see that there was the confronting the zero bound problem. So, at the beginning of 2007-8-9 financial crisis, the Federal Reserve was conducting policy under a Fed fund rate strategy. That means they have been following the Fed fund rate strategy, that the interest rate targeting as the main strategy. So, by the summer of 2008, in an effort to reverse economic downturn, the central bank had reduced the Fed fund rate essentially to zero. That means between 0 to 0.025. That means literally it means that the short term interest rate is very low at the bottom. Literally banks won't pay other banks to take their funds, right. So, this is a zero bound problem. So, that means 0 is the effective lower bound for the federal fund rate or any other nominal interest rate. So, this development led the Federal Reserve to adopt a number of unconventional monetary policy instruments. Though they have been using FFR, now also they are using FFR, that is the interest rate targeting, but especially during 2007-8-9 period, because the deposit and credit creation process endangered by the open market purchase has stalled, and because of this Fed has adopted a large number of unconventional monetary policy instruments. Also you know that during that time, the crisis time, the liquidity with the banking system and overall in the economy was at a very bottom level. There was liquidity crisis, many financial institutions failed, severe liquidity crisis. So, Fed followed several unconventional monetary policy instruments. So, these policy initiatives include large purchases of mortgage backed securities and commercial paper. So, as a part of the bailout package, not only US government but also the Fed fund also engaged in large purchase of mortgage backed securities and commercial paper with the aim to inject liquidity in the economy. So, other actions were loans to hedge funds and other investment firms that were used to finance the purchase of securities backed by student loans, car loans, credit card receivables and etc. So, taken together these initiatives have been called quantitative easing. That means increasing the liquidity in the economy, that means a huge increase in money supply in the economy is called quantitative easing. So, the Fed was seeking to provide credit to a number of sectors of the economy that would otherwise slow down due to the shortage of funds from the banks. So, in order to prevent the recession, in order to prevent the depression, economic depression, Fed used this unconventional monetary policy strategy into 2007-8 period. Moving further, one of the point I didn't explain in the previous class was the implicit anchoring in addition to monetary aggregate targeting and Fed fund rate target, that is interest rate targeting, that is called just do it monetary policy strategy. That means from 1980s up until the time Ben Bernanke became, he became the chair of the Fed Reserve in 2006, the Fed Reserve was able to achieve excellent macroeconomic performance, and it did so without using an explicit nominal anchor such as inflation target or interest rate targeting, etc. So, they have been using interest rate targeting, but they did not use very explicitly these tools, and they have been following some implicit anchoring. Although Fed Reserve did not articulate an explicit strategy, a coherent strategy for the conduct of monetary policy existed nonetheless. So, this strategy involved an implicit but not an explicit nominal anchor in the form of overriding concern on the part of the Federal Reserve to control inflation in the long run. Having discussed these strategies and tactics of monetary policy, let us now look at the recent international experience in conducting monetary policies. So, one of the strategy that is gaining momentum these days is the inflation targeting as a monetary policy strategy. So, inflation targeting, it also can be read along with the independence of the central banks. It is expected that giving an inflation targeting and giving a target that this is the rate of inflation that should be achieved by the central bank using its tools, that the goal is an inflation targeting, this would reduce the effect of political pressures on central banks. So, in general, the move to inflation targeting coincides with a grant of greater independence to central banks. So, because in the previous class, just recall when we discussed two key elements, key dimensions of central bank independence. One is the choosing of tools, that is whether they can use conventional tools within that, the open market operations, discount window, reserve requirement, etc. Or choosing the tools, and other one is choosing the goals. So, mostly the political pressure comes in the choosing of the goals. So, accordingly when they choose the goals, they have to select the appropriate tool as well, right. So, in order to reduce this pressure, the inflation target has been come up as a potential solution, giving the central bank independent control of its policy instruments and a clear mandate to target inflation greatly limits government's ability to manipulate monetary policy for political purpose. So, another pragmatic motivation for the move to inflation targeting in several countries was that they experienced problems similar to those the United States experienced with the monetary aggregates as intermediate targets. So, monetary targets aggregates as the intermediate targets, the issue here is actually the time inconsistency problem, because when they target monetary money supply, so how long it takes the money supply to make an impact on the economy, that the impact on GDP. So, how long it takes. So, that means that there is a time inconsistency problem is there, money supply, even increasing the money supply, how long it takes time to make an impact on rate of interest, and then from there the impact on GDP, how long this would take. And because over period of time so many other factors will come into play, and as a result, suppose increase in money supply is not necessary that it will, because increase in money supply we expect that rate of interest will decline, cost of borrowing will decline, and GDP will increase, right, the investment will increase. But how long this will take, there is a time inconsistency problem, because there are so many other factors also influence this pathway. So, because of this monetary policy, they have been directly started targeting inflation as the one of the nominal variable. So, about inflation targeting, it involves several elements. One is public announcement of medium term numerical objectives for inflation. For example, in India, India's inflation targeting is 4% with a upper and lower bound tolerance level of 2%. So, that means a public announcement of medium term numerical objective, that is the target. And second is an institutional commitment to price stability as the primary long run goal of monetary policy, and a commitment to achieving the inflation goal. Thirdly, an information inclusive approach in which many variables, not just monetary aggregates, are used in making decisions about monetary policy. And fourth one, increased inflation targeting transparency of the monetary policy strategy through communication with the public and the markets about the plans and objectives of monetary policy makers. That means it will increase the transparency, so that the increase inflation targeting transparency, so that suppose they announce that this is the target, and accordingly the public and the market can anticipate that the monetary policy will be coming in order to ensure that the target is achieved. And finally, increase accountability of the central bank for attaining its inflation objective, so that the central bank is now accountable, they are accountable to achieve this target, so that accordingly the policy tools should be implemented, selected and implemented, and they are because since they are accountable, it will be making them more accountable to attaining its inflation objectives. There are several advantages of inflation targeting. The first one is the reduction of the time inconsistency problem. So, the time inconsistency problem arises when a future policy plan is no longer optimal at a later date, even when no new information has arrived in the meantime. So, a policy announcement will be time inconsistent if economic agents know that the policy maker will want to renege on the decision when it comes time to act. Because an explicit numerical inflation target increases the accountability of the central bank, inflation targeting can reduce the likelihood that central bank will fall into the time inconsistency trap of trying to expand output and employment in the short run by pursuing an overly expansionary monetary policy. Second advantage, the proponents of inflation targeting argue that this would increase transparency. That means inflation targeting has the advantage that it is readily understood by the public and is thus highly transparent. And the third point in favor of inflation targeting is that it increase accountability. So, the tendency toward increase accountability of the central bank, it increases the tendency toward increase accountability of the central bank to achieve the target. Indeed, transparency, we can see that both transparency and communication it go hand in hand with the increased accountability. Other arguments is that this is consistent with the democratic principles, especially when we talk about independence of central bank. We have seen in previous discussion that most of the time the critics of central bank independence argue that they believe that the monetary authorities, they are elite groups, they are not elected through democratic channel, not elected directly by the public. However, giving these principles, that giving a mandate that the inflation targeting, this actually the proponents argue that this is consistent with the democratic principles. So, not only is accountability valuable in its own right, but it also make institutional framework for the conduct of monetary policy more consistent with the democratic principles. So, to shortly, the inflation targeting framework promotes the accountability of the central bank to elected officials who are given some responsibility for setting the goals of monetary policy and then monitoring the economic outcomes. And in addition, it also increases the improved performance. Inflation targeting countries seem to have significantly reduced both the rate of inflation and inflation expectations beyond what likely would have occurred in the absence of inflation targets. The disadvantage is there is delayed signaling, because this is actually the critics point out that inflation is not easily controlled by the monetary authorities, because there are other factors are also there. Furthermore, because of long lags in the effects of monetary policy, inflation outcomes are revealed only after a substantial lag. So, other arguments against this is too much rigidity. That means some economists criticize inflation targeting because they believe it imposes a rigid rule on monetary policy makers and limits their ability to respond to unforeseen circumstances, because they have given the mandate of inflation targeting, that is to achieve the target and to ensure inflation, the price stability. Further things are is a potential for increased outflow fluctuations, and also giving too much importance on the inflation stability, they sometimes ignore the economic growth. It has been found that sometimes in order to ensure sound economic growth, it is better to follow increase the expansionary monetary policy by increasing money supply or reducing rate of interest, so that the GDP can be increased. But sometimes, since the mandate for the monetary policy is mainly the inflation targeting, so most often they increase money supply, and as a result instead of reduced rate of interest increase and GDP growth is hampered. The pace at which GDP grows is often hampered because of inflation targeting. So, let us now review some international recent international experience. So, the inflation targeting, it has been, especially New Zealand government, they followed, they are the champion in introducing in the inflation targeting. So, the New Zealand Reserve Bank Act of 1989, so the prime function of the Reserve Bank of New Zealand is to maintain the stability in the general level of prices. So, the act mandates that the Minister of Finance and the Governor of the Reserve Bank agree on monetary policy targets to achieve price stability. So, much of the 1990s, price stability was defined as an inflation rate within a range of 0 to 2%. So, in 1997, this definition was loosened a bit to a range of 0.3%. So, the Reserve Bank is then free to choose the strategy that it believes will best achieve the policy target. So, this is the New Zealand was the champion here. They followed it and started it in 1989. Then other countries, Canada made an announcement, joint announcement by the Minister of Finance and the Governor of the Bank of Canada. They established a formal inflation target in 1991. So, they announced this policy, and as a result empirical evidences suggest that inflation decreased since 1991. Then the United Kingdom adopted an inflation target as its nominal anchor in 1992, and as a result initially they set up the target of 1% to 4%. Then in subsequent period in 1997 the inflation target was set at 2.5%, and again the empirical evidences suggest that they were able to achieve the target. Inflation has been close to its target, and growth has been strong, and unemployment has been decreasing. All this actually mainly because as a response of 1970s 80s period, you can see that the stagflation, that is hyperinflation. Then these countries they followed inflation targeting. Then the empirical evidences also suggest that the New Zealand and Canada and United Kingdom experiment with inflation targeting is resulted in achieving the desired result, because these are the years when they implemented started inflation targeting. Then you can see the inflation rate on the y axis of this figure, and time period is given on the x axis. Then you can see that the inflation, you can see that inflation has been declining, right. So, inflation target, that the inflation rate has been declining over period of time. So, you can also see the green line, that is the target range, and the red line shows the actual inflation rate, and you can see that for New Zealand and for UK, Canada and UK, you can see that the inflation rate has been declining, and they are having a stable inflation after adopting the strategy of inflation targeting. So, this is the New Zealand, and Canada and UK, you can see that the inflation rate has been declining, and they are having a stable inflation after adopting the strategy of inflation targeting. So, this is the New Zealand, and Canada and UK, you can see that the inflation rate has been declining, and they are having a stable inflation after adopting the strategy of inflation targeting. So in this session we have discussed the various strategies used by the Fed, and then subsequently we discussed the new strategy, that is actually inflation targeting. And I want to again highlight that in parallel to that, in order to achieve the inflation targeting, still the other intermediate targets, that the monetary aggregates and interest rate targeting is still being used. And in the next session, let's continue this discussion and see what are the further developments in the monetary policy strategy and tactics. Thank you for watching this video, and see you in the next session. Thank you.